Welcome back everyone, I hope you're having a great day, and in this video we're going to take a look at every single dividend paying company I own right now in my $151,000 dividend growth portfolio. If you're new to the channel, I'm the Gen Z investor, and my goal is to continuously build up this stock portfolio with blue chip dividend paying companies that provide their investors with growing passive income year after year, so that one day I can achieve true financial freedom and the dividend income I collect passively is enough to cover all my monthly expenses, and I no longer have to go work a job in order to earn my income. So right now we're in the building stage of that goal with the portfolio value just over $151,000. And like I mentioned in this episode, I'm going to go through every single stock that I own, currently sitting at around 23 different individual companies within the portfolio. I'm going to give my thoughts on each one, my overall thought process on whether I'll be adding to the position right now or if I'm going to let it sit, how much dividend income I collect from each company, and overall my sector diversification amongst the market at this current point in time. But before I jump into the first company, I am going to ask you to please hit that like button and subscribe. I post every single week talking about the stock market, going over different stock market news. I share the growth of my portfolio, and I talk about anything dividend related. So please hit that like button, subscribe for future videos. And now we're going to move on to my portfolio tracking spreadsheet, which is a simple Excel sheet that I created to track all my different individual holdings in one simple snapshot. So you can see I have all the different companies that I own, the amount of shares of each holding that I have right now, and the current share price at market close of the previous trading day. Of course, I have the total market value of each position, followed by the book cost overall, and my individual cost per share. And then in the gain or loss column, I have them in green if I'm in the positives or in a gain position, and of course the numbers in the red are my current losses, but these are all unrealized as I'm holding the positions right now. We can see the overall change in each position, the annual dividend that's paid out per share per holding, and of course the current yield on the position, and the annual dividend income I collect from each individual stock overall, and the allocation within my portfolio. And why I have created this spreadsheet is because I own stocks in many different accounts. I use various brokerages in order to test out the different features that they offer and determine which one I like best. So right now I needed a simplified view of my entire portfolio all at once, all my different holdings consolidated into one easy snapshot, and that's why I created this Excel tracking spreadsheet. And if you ever want to view my portfolio on your own time, there is a link in the description down below that allows you to view this portfolio spreadsheet at any time whenever you want, and I update this whenever I make a change in my portfolio, so this is the most recent up-to-date positions that I own right now. So now if we jump into each individual holding, we're going to go sector by sector, and I'm going to share with you why I own the company and my thoughts going forward. So the first stock we're going to take a look at is Apple. I own 126 shares with a market value just over $17,000. So overall, I do believe Apple is one of the strongest companies in the world. I know they are one of the largest in terms of market cap at this current point in time, and I don't think there's many companies right now that will actually knock Apple off of their market leadership position. I think the company is doing a great job focusing on subscription revenue going forward. Their services business is growing at a rapid rate quarter over quarter, and I do believe going forward that Apple will continue to bring in large amounts of cash flow, continue to do stock buybacks, and provide a growing dividend to the investors over the long term. So this is currently the second largest position in my portfolio, and I feel very comfortable holding them for many years down the road. And now if we take a look at stock number 2, we have Microsoft. Of course, another tech giant up there with Apple. They have some of the best subscription-based revenue models in the world, and this is just a beast of a company. They have one of the best balance sheets I've ever seen, growing cash flow year over year, and overall, there's nothing but good things I have to say about this company, and that's why I feel comfortable having it as the largest position within my portfolio, making up around 12.7% of the total portfolio's value. So right away, you can see I have around 23% of the portfolio with just in Apple and Microsoft. So the tech sector is heavily weighted towards these two companies. And now if we move on into stock number 3 and 4, I'm going to talk about these two companies together because they are very similar. I have Visa and MasterCard, two giants in the financial tech industry. In my portfolio right now, I do have them sectored under tech. That is up to debate amongst who you talk to, but I think they're most categorized under tech just because of the nature of their services. They don't offer any physical retail or anything like that. It's more of a financial services, financial tech service business, so I group them under the tech heading. I own 21 shares of Visa and 16 shares of Microsoft with corresponding values of $3,800 and $4,700. You can see I'm pretty much broke even on Visa. up only 0.88% or $33, which is a minimal unrealized gain. And overall on MasterCard, I'm currently in the red by $268 or just over 5%. These companies had seen incredible growth over the past few years. Of course, with the recent market turmoil, we have seen that growth mediate down to a more break-even level, I would say, in my portfolio, but I do plan to hold them over the long term. They're very high margin businesses. They have huge net margins overall, and because of that, they provide great dividend growth to their investors. The starting yield is minimal. You can see at only 0.66% for MasterCard and only 0.82% for Visa at this current point in time, but they offer investors some incredible dividend growth over the long term. And you can see I only have 2.5% of my portfolio in Visa and 3% in MasterCard. So these are relatively small positions. So they're nothing major within the portfolio, and I do plan to hold them going forward over the long term. And now we're going to move on into stocks 5 and 6 within the portfolio, and those are Broadcom and Qualcomm. These are two major players in the semiconductor industry, which I think is going to be very profitable going forward. So instead of just picking one company in the industry, I went with two brands that I like right now, and overall I think Broadcom and Qualcomm will see continued success over the long term. So in Broadcom right now, I own 10 shares, $460 per share market value, so with a position value right around $4,600, and I'm pretty much break even on this position. I was up significantly, but of course with the market pullback, that has come down to right around the break even level. They pay $16.40 per share in a dividend per year. So right now I earn $164 from this company every single year. Then of course, followed by that, we have Qualcomm, another major player in the semiconductor industry. I own 40 shares with a position right around $4,800, and I'm down around 5% overall. These are again companies I plan to own long term. A common trend you'll see with every single company I have in my portfolio right now, I never play on market timing. I never go short-term investment thesis. I'm always long-term. So with the 6 companies we've gone over in the tech sector, these are all brands I plan to own for the next 5, 7, 10 plus years going forward. I have no intention of selling them anytime soon, and that's a common theme with all the stocks in my portfolio at this current point in time. I follow the investment strategies of some of the greats, like Warren Buffett. Buy companies. I don't buy stocks, I buy companies. I buy shares of some of the best companies I believe on the market, and I want to be an owner of them over the long term. I want to collect my dividends. I want to see that dividend income grow, and I want to be part owner as the companies grow their income over the longer term. So that's a pretty common theme amongst my portfolio. Those are the 6 tech companies I own right now, and I don't see myself deploying any more capital into this industry. Tech makes up around 36% of the portfolio value right now. I am comfortable with that level, but I don't see myself deploying any more capital at this current point in time. And now we're going to move on into the second sector within my portfolio, and that is the financial sector. I own 4 names within this industry: JP Morgan Chase, Bank of America, Toronto Dominion Bank, and BlackRock. 3 main traditional banks, and then BlackRock, more of an investment style bank, one of the leaders in assets under management within North America. And overall, I am a believer in the financial sector. They have good margins. They provide growing net income over the longer term. Of course, there are turmoil depending on the economical environment, but I do believe going forward, banks are still going to be very strong. And I chose the 2 largest in America with JP Morgan Chase and Bank of America. I chose one of the leaders in the Canadian industry with TD Bank, who also has a major, geographical region within the United States as well. And then I went with BlackRock, one of the largest asset management companies on the planet. So those are the 4 different holdings in the portfolio right now. 2 slightly in the green, 2 holdings in the red. You can see I have $7,200 worth of value in JP Morgan Chase, by far the largest in the industry, followed by around $3,000 in the other 3 names. So of course, I don't like picking the individual winner. I'm not the type of investor who's going to pick one bank and put all their eggs in that one single bank. I like owning a few different names within the industry. I like the average. I'd rather pick 3 good winners consistent going forward than trying to pick the one and missing out on other performance because I solely reliant on one single firm. Many people can disagree with that strategy, but that's just what I do. It's what I personally feel comfortable with. I like spreading my capital amongst a few different names, and JP Morgan Chase, Bank of America, TD, and BlackRock are the 4 holdings within the financial sector I have right now. And we can see right away, financials, another significant portion of the portfolio, making up 11.2% of the overall value. And now continuing on into the next sector, we have Verizon. It is the only communications company that I own in my portfolio. I have 100 shares. They currently trade for $36, so just over $3,600 in total market value, and I am down significantly within this position, down around 30% overall, or just under $1,600 in the red. Verizon is one of those consistent, boring companies generating consistent cash flow year after year. They are a high-yielding dividend payer with a current yield just above 7%, and I collect $261 in Verizon every single year in growing passive income. So I don't have much to say about this company. This is a play more for their higher yield. Of course, the recent pullback isn't great to see, but I am going to hold. I have no intention of selling. Verizon continues to generate slightly growing revenue year after year. It's one of those boring bond-like companies. I don't see much to it. I don't have it as a major contributing factor in the portfolio. It only makes up 2.44%. I will not be adding to it. I have no intention of buying this dip right now, but I am going to hold going forward, hopefully see those gains come back and collect the dividends as I wait. And now if we move on into the next sector, we have the healthcare names. I only own 2 names within the sector, and that is AbbVie and Johnson & Johnson. 2 companies, nice consistent dividend payers. Johnson & Johnson is of course a dividend king with over 50 consecutive years of dividend growth. I'm currently in the green on both positions by a decent amount. Johnson & Johnson I'm up around 20%, and AbbVie has seen some major share price appreciation, and I'm up over 70% on the company, up $2,400 in unrealized gains, and both companies offer some good dividend yields at this current point in time. AbbVie slightly above 4%, and Johnson & Johnson at 2.8% right now. We can see total I have around 7% of the portfolio in the healthcare sector. I'm not major into healthcare, and that's because I truly don't understand the businesses too well. I only like investing in companies that I can accurately understand how they generate revenue, and I have a view and a perspective of how they're going to generate more income over the longer term compared to where they are today. With the healthcare companies, I don't really get that vision, so I have minimal exposure to the industry. I just picked 2 names I like, I'm comfortable with, they have solid fundamentals, and I believe going forward these will be nice brands that provide me some growing passive income. And now next, we're going to take a look at the consumer companies within my portfolio, starting with my 2 consumer discretionary brands in Home Depot and Lowe's. 2 companies we've all heard of. They're pretty much staples in every community across North America. They operate within the same sector, they're direct competitors, and instead of picking which one will do better over the long term, I just split the difference and I purchased both. So I own 18 shares of Home Depot, current market value around $5,100, and around 30 shares of Lowe's, just under $6,000 of current market value. I'm in the green on both positions. They're nice, fast dividend growth companies. They both grow their dividend at a double-digit rate year after year. With the pandemic, they did perform very well. Consumers were forced to stay home, so they spent money on home improvement projects, which is of course the exact industry that these 2 companies operate within. Over this current year, there might be a slight return because people already purchased all their goods. Sales might not grow dramatically like we saw over the past few years, but I do think over the longer term, Home Depot and Lowe's are still going to perform very well. Because the products that they sell are more based on in-person shopping, it's very hard to buy those goods that they sell online. You have to see it, you have to touch it, you have to know exactly what you're purchasing. It's very tough to buy that type of tools, building supplies, all different renovation equipment, different home furnishing projects. Like, it's very tough to do that online. Those are more things you have to see and so you have to feel, you have to understand what it is, what you're actually purchasing. And I think Home Depot and Lowe's offer consumers great ways to do that. They already have the distribution network. They already have locations all around North America. And I don't see any other competitor knocking them out as the 1 and 2 in the home improvement sector. So I do plan to own both going forward. Now, continuing on into the second largest sector within my portfolio, we have the consumer staples: Costco, Pepsi, Procter & Gamble, and Kimberly Clark. I own 4 companies in this industry, and this is one of my favorite sectors to be an investor in. You want to own companies that will make money no matter what's going on in the economy, and that's what these 4 companies are doing right now. Even with record high inflation, different economic turmoil, the fears of a growing recession, all 4 of these companies continue to sell products and continue to make great money. Costco, I believe, is the greatest retailer on the planet, so I own around 18 shares of that company for a value of just over $8,000, and I'm up 41%. The company's just a beast, continuing to post great numbers quarter after quarter, followed by Pepsi, which is actually the 3rd largest position in my portfolio overall, and I just love this brand. They own an umbrella of companies. They own over 20 different brands that sell over $1 billion of revenue each year. So they're highly diversified. They're not solely focused on the Pepsi brand of products in order to generate revenue. They have dozens and dozens of different beverage and snack food options that are all seeing growing market share in grocery stores all across the world. So Pepsi, the third largest position in my portfolio, market value just over $13,000. I'm up 33% overall on this holding, and it pays me $381 in dividends every single year. Following Pepsi, we have Procter & Gamble. I own 40 shares, another consumer beast, a dividend king. I have around $5,000 in this stock, down just over 5%, but this is a brand I think will be in operation for the next 100 years. They operate in 10 different consumer categories. All 10 of their categories have seen organic sales growth over the past quarter, so all the different product segments that they operate within are growing and seeing more and more revenue quarter after quarter, and they own the market-leading brand within each category. You go to any convenience store, grocery store, home improvement store, you're going to find Procter & Gamble products there on the shelves, dominating much more than all their competitors. And I think Procter & Gamble as a whole is just such a consistently stable company for a company that's been in operation as long as it has to still post revenue growth year over year, to be consistently growing their dividend and buying back shares. It's just the perfect business model for me. I like to own them. They are a larger position in my portfolio, making up around 3.3% relative to all the other smaller holdings, which sit just below 3%. And of course, another brand, no intention of selling, and I will actually continue to buy more if the stock continues to fall in price. And finally, the fourth consumer staple I have is Kimberly Clark. They operate similar to Procter & Gamble, just don't have as much success. Their products aren't as well known. They still have market-leading brands, but not to the level and the scale as Procter & Gamble. So I consider them like a number 2 or a number 3 in the consumer staple industry. I bought in at a good valuation. The company has still fallen from where I bought them. I'm down 15%. But overall, when I made my entry into the stock at $128, I was very comfortable with it. They have a very safe dividend. They grow it consistently over the long term. And with a yield above 4% and a company that sells consumer goods that will always be sold year after year, it's a nice holding in my portfolio. Nothing crazy, nothing dramatic, but I am comfortable with my KMB position right now. So those were my 4 consumer staple brands. I do love this sector. If there's any deals in the market and these companies continue to fall, I have no problem deploying more capital into this industry, or maybe even adding a different consumer brand if I see the price is right. And now if we continue on into my utility sector, I own Duke Energy, Southern Company, and NextEra. 3 different brands, 3 very consistent dividend growers in the utility industry. Again, these are more like bond-like companies. They offer a higher starting yield with not as much growth, and that's what I like about the industry. As a dividend investor, of course, you have to dabble into the higher yield companies, and utilities provide a great sector for just that. Overall, I am in the green on all 3 positions. I'm up around 6% in Duke, 24% in Southern Company, and just over 13% in NextEra Energy. NextEra is my play in towards the more renewable space. They do have fast-growing renewable sector. They have different solar panel, hydro, and different plays on the consumer renewable industry. So that's kind of my exposure to that, because I do believe over the longer term that will be growing. I don't think we're there just yet, but I think over the next decade or 2, renewables are going to be a major player in our market. I think NextEra has done a great job of actually entering into that space. Right now, I'm trying to become a leader in it as they continue to grow. So those are the 3 energy companies or utility companies that I own. Nothing too dramatic. Duke and Southern are very well known by dividend investors. Pretty common, high yield, consistent companies that provide a consistent inflation-beating dividend growth over the longer term period. And finally, the last company that I own in the portfolio is my only industrial play, and that is Canadian National Railway. I own 38 shares for a market value of just over $4,000, and I'm up 19% overall, and they offer a lower starting yield right at 2%, and they pay me $83.60 every single year in growing dividend income. They do provide investors with a nice dividend growth in the higher end between 8 to 10% per year, and this is more of a growth play. And I did want to own one industrial/railway company because I actually do like that industry. It may be a weird one to say that I'm into, but we're not building any new railway infrastructure. The infrastructure that's in place right now is pretty much all we're going to have, with slight improvements going forward, but no legislation's coming out building thousands and thousands and tens of thousands of miles of railroad. It's just not happening right now. So having a few companies who are dominant in that sector, I would name 3: Canadian National Railway, Union Pacific, and Canadian Pacific as 3 major players in the northern part of North America. I just want to have one. The company performs well, the financials are solid, they have a nice balance sheet, and overall, It's my one exposure into the industrial sector, just under 3% of the portfolio, so nothing major, but it is my only industrial play at this current point in time. And right now I have a little bit heavy in cash. Usually I'm not really a cash investor. Usually I am fully invested, don't have anything sitting in cash. But right now I have around $6,000 in cash in the portfolio, just looking for my next purchase. I don't know exactly what it's going to be right now, but I am in the market for a good buy. And if something comes up, I have the capital ready to deploy and make a buy on any dip I see. So overall, this is my sector diversification. We went through every company that I own, took a look at all the different brands, and I gave you a quick overview of each. In future videos, of course, I'll go more in depth. I'll show the financials of each company. I'll bring you up their investor presentation to show you how they generate revenue and their plans for the future. But right now, these are the companies that I own and the brands that I plan to own for many years down the road. The only time I sell a company is if the fundamentals of the business change. Meaning if something happens to the company itself that changes the overarching way they generate revenue, how they produce cash flow, how they're able to pay their dividend, or anything that changes the business dramatically that I don't agree with, that's when I'll sell a company. I don't sell a company if they have a bad quarter, if they miss expectations. One thing that people don't understand are expectations are set by the market. They're not set really by anyone. They're set by potential investors like you or me. Every single quarter for all my companies, I could set revenue expectations. I could be overly optimistic or pessimistic. I could base my expectations on whatever my mood is that day, and that could determine investor sentiment on a stock. For example, if expectations for one quarter are very pessimistic and the company performs average, but it beats that pessimistic expectation, people think the company did great. They beat expectations by 10%. That's not really as accurate compared to another investor who may be more optimistic on their expectations. The company may perform great, but the overall analyst was way too optimistic and the company misses that expectation and the stock falls because investors believe the company's failing. So I don't like that type of investing. That's not who I am. I don't like the short-term nature of these expectations over quarter. Of course, I track every single quarter of my companies and make sure they're performing well overall, but I don't base my investment decisions on a single quarter, 2 quarters, or even a year. I only sell a company if I believe the fundamentals have changed or if the company has grown way too large in market position and I think the company's overarching weight in my portfolio is too high and I may trim it a little bit, but I don't really make frequent buys or sells. I usually pick a company, research it in depth, understand their business and how they generate cash flow, and then if I like the brand, I think it's going to continue to grow cash flow going forward, then I'll make it an addition to the portfolio. And of course, any buys or sells I ever make, I always share on the channel to keep you updated on my portfolio and the growth overall. So I want to thank you. We took a look at every single company I have in my portfolio. As you can see here, the total portfolio value sits at over $151,000. It pays me $3,478 in annual dividend income, and my dividend growth on average over the past 5 years has been at 9.5%. So very fast, very consistent dividend growth. These are the companies I own right now. No intention of selling all the brands. I want to thank you for staying tuned all the way to the end. This was a longer video. I appreciate the support. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.